A very good morning, dear students. We are in a new month. I wish that may October bring you a month filled with happiness, love, laughter, and all that your heart truly desires. We are going to begin a new chapter in accountancy, which is called Theory Base of Accounting. Theory Base of Accounting is a chapter which consists of principles, concepts, rules, and guidelines developed over a period of time to bring uniformity and consistency to the process of accounting and also enhance its utility to different users of accounting information. Let me take you all to the definition of accounting. What did we understand by accounting, children? Accounting is the process of identifying, recording, classifying, measuring, and summarizing all those transactions which are of financial character and also interpreting the results thereof. Having said the process of accounting, isn't it necessary for us to have certain rules and guidelines to carry on the process of accounting? Yes, it is very important for us to abide to certain rules and guidelines that will help us to have an uniformity and consistent process of accounting. The reason being because we have a wide range of users who are dependent on accounting information. When the accounting process is uniform and consistent, the users can understand the accounting information much better. Let me introduce you to the concept of GAAP. What is GAAP? GAAP stands for Generally Accepted Accounting Principles. It refers to the rules or guidelines adopted for recording and reporting business transactions. What are the business transactions that the business faces, children? Purchase of an asset, sale of an asset, receipt of money, payment of money. These are the transactions that keeps happening in a business. The rules and the guidelines has been adapted so that the recording and reporting of these transactions are done in an accurate way so that it can help us to prepare an uniform financial statements. In other words, it can bring a uniformity in the preparation and presentation of financial statements. We all know that financial statements is basically the accounting information where most of the users are dependent on. Please remember, these principles are also referred to as concepts and conventions. I have introduced you all to two new terms, which is concepts and conventions. Let us try to understand what do we mean by concept. Accounting concepts refers to the necessary assumption and ideas which are fundamental to accounting practice. We know what are the process of accounting. It is identifying, recording, classifying, measuring, and summarizing. Now, an assumption or an idea in order to carry on the process of accounting is what we call concept. On the other hand, we have accounting convention. What is accounting convention? It refers to the customs or the traditions as a guide for the preparation of accounting statements. Now, having completed the accounting process, that is identifying, recording, classifying, measuring, summarizing, having done all the process of accounting, the next thing is we have to prepare the financial statements. In order to prepare the financial statements, we have to abide to the accounting conventions. Please remember, children, An assumption or an idea is concept. Customs and traditions, it's basically the guide for preparing the accounting statements, is convention. In today's class, we are going to see the accounting concepts. There are 9 accounting concepts. They are the basic accounting concepts, very easy to understand. You just have to remember the keynotes. Let us start with the first one. Business entity concept. What is business entity concept? Now, before we start looking at individual concepts, children, remember the meaning of concept. What is concept? It refers to the assumption or the idea that we are going to use in the process of accounting. Okay, with that note, let us read this business entity concept. According to this concept, the business concern is considered to be separate from that of the owner or proprietor who owns, runs and manages the business. So basically, business is separate from that of the owners of the business. Okay, so this is the key thing that you have to remember. What is the key phrase for this particular concept? The business is going to be a separate entity. The owners of the business are going to be the separate entity. They should not be mixed with each other. When I say mixed with each other, only business transactions will be recorded in the books of accounts. The personal transactions of the owners of the business will not be recorded in the books of accounts. That is why I say business is a separate entity. Owners of the business are a separate entity. Owners are otherwise called as proprietors. Look into the example, children. A car purchased by the owner for personal use is not recorded in the books of accounts of the business. But if the same car is purchased for the business purpose, we can record that particular transaction in the books of accounts. But if it is used for its own personal use, you cannot mix it with the books of accounts related to the business transaction. So in short, please remember, business is separate. The owners of the business are separate. Whatever transaction happens, it should not be mixed until and unless it is related to business. This is the first concept. Let us go to the next concept. Money measurement concept. What is money measurement concept? According to this concept, the transactions that are measurable in terms of money are only eligible to be recorded in the books of accounts of the concern. I have been telling you all this right from the beginning. When we learn the definition of accounting also, I told you all, you will be recording only those transactions which are of financial character. In other words, which are of monetary units. Only the transactions which are measurable, which has a value, only those transactions will be considered in the books of accounts. The non-monetary values cannot be considered in the books of accounts. What could be the monetary transactions, children? The sale of goods, payment of expenses, receipt on income, all these are the examples of monetary transactions. So when I say money measurement concept, please remember it is a concept which makes sure that the transaction which involves money is only recorded in the books of accounts. You cannot record the non-monetary transactions. Let us go to the third concept. Going concern concept. According to this concept, the operations of the business concerns must carry on whether the owner of the business exists or not. It assumes that the business has a perpetual existence, that is, indefinite life. What do I mean by going concern concept, children? Whether the owner is existing or not, the life of the business is indefinite. You cannot restrict it on certain age. You cannot say after 10 years the business is no more, after 20 years the business is no more. You can't keep a definite life period for a business. It is indefinite by its nature. The life of the business is indefinite. It cannot be restricted on age. That's why the last line clearly says it has its perpetual existence. Lifelong, it can keep existing in the global environment. This is going concern concept. The next one is accounting period concept. What is accounting period concept? According to this concept, the transactions that have taken place for a period of a year or 12 months are to be recorded in the books of accounts. Now, I told you all the life of a business is indefinite. Now, in order to provide accounting information, we are dividing the life of the business into one year. We are going to calculate the financial position, the profit and loss, the expenses, incomes based on individual year. When I say individual year, for 12 months. Now, in accounting, we have two types of calendar, children. Please look. The accounting year may be the English calendar. What is English calendar? It can start from 1st January and end on 31st December. If not English calendar, it can go to the financial year of the government. That is a calendar as per the government laws. When do they actually start their financial year? 1st April of the current year. When I say current year, of the present year, and it closes on the 31st March of the next year. So for example, we are in the year of 2020. If I'm going to start my books of accounts on 1st April 2020, I have to close the financial statement on 31st March 2021. So what happens? Though we say the life of the business is indefinite, in order to ascertain the financial position, to find out how much is the profit, loss, expenses, incomes, to calculate all these financial units, we are going to divide the life of the business into one accounting year, individual accounting year. When I say year, it should be of 12 months. It can start from 1st January to 31st, or it can start from 1st April of the current year and end on 31st March of the next year. So this is one of the concept. The next one is cost concept. What is cost? Immediately remember the meaning of cost. It is the amount that we are going to pay or spend in order to buy a product or a service. That is the meaning of cost. Am I right, children? What does cost concept say? What is the other word for cost concept? Historical concept. We might ask you all for 1 marker. Cost concept is otherwise known as historical concept. What does this concept tell us? The cost concept means that an asset acquired by a concern is recorded in the books of accounts at a cost. That is, the price actually paid for acquiring the asset, which includes cost of acquisition, transportation, installation, and making the asset ready to use. The market price of the asset is ignored. Whatever amount I'm spending to buy an economic resource, that amount is what I have to record in the books of accounts. I should not record the market price, which is very, very important. And when I say cost price, it should include transportation cost, installation cost, and then making the asset ready to use. Whatever expenses is there, we have to consider along with the cost price. Let me give you an example. I have bought a machine worth 10,000 rupees. Now for transportation I have spent 1,000, for installation I have spent some 2,000, and then to make the asset ready to use I have spent another 2,000. So basically 5,000 extra I have paid. When I am recording in the books of accounts, I will take 15,000 and not 10,000. So whatever amount I am going to spend to get that machinery is what I will be recording in my books of accounts. That is what the cost concepts tells us. Okay. So the next one, dual aspect concept. Children, this is one of the most important concept. We are going to solve all our practical problems based on this particular concept. What does this concept say? For every debit, there is a credit. I'll tell you what is this debit and credit. According to this concept, there must be two aspects, that is the debit and the credit aspect for every transaction. Both the aspects of each and every transaction has to be recorded in the books of accounts. Okay, now you'll have to understand this concept of debit and credit. Now for example, I am selling goods to the customers who, when I say I am referring it to as business. The business is selling goods to its customers. So two things will happen, children. Whatever goods the business is selling, what happens? Will that goods be with us in the business? Absolutely no. The goods are going to the customers, and once the goods are going to the customers, what is the customer giving to us? He's giving us money. So what happens? The goods are going out, money is coming inside. So this is what we call as debit and credit. We have lot more to talk, children. When we come to debit and credit, there is lot that we have to cover. For now, try to understand any transaction that takes place. No, there is two aspects involved, a debit transaction and a credit transaction. When I say debit, it's basically, it depends on different types of accounts, which you will be learning in the future classes. For now, you should, all that you have to understand, any transaction that you take place, in return there is another transaction coming up. If I sell goods, I am getting money. If I purchase a machinery, I have to give money. So basically two transactions are taking place for one event. So this is what we say as dual aspect concept. Very, very important. It is also called as duality concept. For every debit, there is credit. Remember this word so that when we go to the next chapter, the only thing that we will be studying in the next chapter is debit, credit. It should be equal. I am purchasing a machinery for 1 lakh. Money of worth 1 lakh is going out. I am selling goods for 10,000 rupees. I am getting 10,000 rupees money in return. So this is the twofold aspects that is getting involved in a transaction. The next concept, revenue recognition or realization concept. Just like how for cost we had another word historical, here for revenue recognition another word is realization concept. What does this concept tell us? According to this concept, the revenue earned by a business concern through sales is to be recognized in the books of accounts only if the customer becomes liable to pay the amount legally. Please remember, children, when I say revenue recognition, I have sold the goods to the customers. Only when the customer agrees to pay, that's when we say that the revenue is being earned. We can say that we are going to receive money. Just selling goods is not enough for the business. They have to get money in return. Only when we understand that the customer is ready to pay the money for the goods, that's when we say revenue is being recognized. Without receiving the money for the goods that we have sold, we cannot say that we have got an income. Am I right, children? We know what is the meaning of revenue now. Am I right? So what happens when I'm selling a goods, I have to get money in return. That's when I can say there is some income that I'm going to get. But after selling the goods, and if there's no any promise payment from the customers, I cannot say that the revenue has been recognized. So revenue recognition is a concept which tells us that when you are rendering the products or the services, if the customer is promising to pay legally, that's when we say that the revenue is being recognized. Till then, we cannot say that we are going to get a revenue. The next concept is matching concept. What is matching concept? According to this concept, profit is the result of two factors, that is revenue and expenses. So the measurement or the determination of profit and loss, these two factors are to be matched or compared, and the result is the net loss or net profit. Now, what is this profit, children? How can we earn a profit? We have to incur some expenses. After incurring some expenses, we'll get one final product or service. If we sell that, we can get a return. So it basically has two factors. Revenue also should take place, expenses also should take place. Am I right? So when we have to determine the profit or loss, these two factors should also match. Only when they match, we say that we can get a net profit or a net loss. If I have made more expenses, that means I will have more loss. If I have made more income, that is, if I have made more revenues, that means I have got more profit. So this is what we call as matching concept. More revenues, more profit. More expenses, more losses. So this is matching concept. Next one is objectivity concept. What is objectivity concept? According to this concept, the material facts must be disclosed in the financial statements with sufficient details. The objectivity concept means that all the accounting entries should be evidence and supported by source documents or business such as invoice, vouchers, etc. I have told you all, children, whatever transactions we are recording in the books of accounts, it should be evident. When I say evident, it should have source documents. It is very, very important. And all these are your assumptions, children. So long, whatever concepts that we have read so far, it is all the assumptions or the ideas that we are going to consider in the accounting process. It might vary from organization to organization. It might vary from one business activity to another business activity. It is not hard and fast rule that they have to stick on to one particular concept. They can, now see, when I was talking about the accounting period concept, a company can follow from 1st January to 31st December. If not, the other business can follow from 1st April to 31st March. So these are the assumptions and ideas that we will be involving in the accounting process. And I had told you all, whenever we are going to carry on any transactions, it should be evident with source documents. That is the last concept that we have read. So that's all for today's class, children. We have completed all the accounting concepts. Any doubts, we will get it clarified in the subject group. Thank you, children. Have a nice day. God bless you all.